All right, welcome everyone. My name is Jesse Randall. I'm the CEO and co-founder of Sweater, and Sweater is the main sponsor of Founder Saga, which is the reason that we are all here today. And joining us is John Mayfield, who's one of the partners at Album VC out of Utah. Welcome.
Thank you. Thanks for having me.
Yeah, we're excited to have you here. Founder Saga at the outset was really designed for telling founder stories, but I'm excited to bring you in and talk about kind of the other side of the equation, which for many founders is examining what is going through the mind of that investor that's sitting across the table or on the other side of that email thread that they're having as they try to navigate the waters to advance their companies. So, like you and I talked about, I think we want to make this a frank discussion and kind of candid around what you see and what constitutes specifically around kind of the storytelling aspect of what's happened inside your company, right? So there's always like what comes out in a pitch deck and telling that story. That's the story of the business as it's told in that context. But ultimately, before you or Album VC or an angel investor or anybody else decides to make an investment, there's another part of the story that is told or discovered, which is more behind the scenes and understanding the path that those entrepreneurs took to get to that point, and ultimately to make sure that that they fit a risk profile and match, I think, certain points, not necessarily a checklist, but more like, and you can tell me I'm wrong on this, but more like a sniff test, right? To make sure that everything checks out in the right way, because everybody's got a different story. And I think it's important that founders understand how to tell their story in the best way possible, because everybody's got a rocky path in some way, shape, or form. So why don't we open it up to that and go ahead and get started? What do you think?
Great. Yeah, appreciate that intro.
Yeah.
So I don't know if you want.
Maybe
why
don't we start with let's start with getting into your background. Tell everybody a little bit about Album. Tell about your investment philosophy a little bit, if you'd like, your thesis and what you like to see. That'd be great.
Yeah, no, I think that's a good place to start. So thanks for having me on. We've been friends for quite a few years, so you've kind of followed my journey along with me following yours. So appreciate this opportunity. So John Mayfield, I'm a partner at early stage venture fund here in Utah, Album, like Jesse mentioned. I have been here for, I guess it's 6.5 years. That's as long as we've been around. So we're kind of one of the newer funds around, I guess you could still say. In Utah, there are a number of funds, but for a long time, most of the funds kind of trace their history back to, either Novell or, Zions Bank in some way, or, some of the V-Spring people from who started 20 years ago. We're kind of one of the unique funds who don't have that history. We kind of just sprouted from the earth and kind of benefited from, we are kind of a off one of the flyover states, or kind of a secondary or kind of third tier tech community. But with the rise of a lot of the big exits that have happened here the last 10 years, I think we've just kind of benefited from that. So it was kind of fertile ground for us to sprout. And we started, we were called Peak Ventures in the beginning. We had a unique founding history. We were kind of raised, there was a separate business that was more focused on real estate, but had a highly entrepreneurial founding team. And they had done some angel investments, and that's how I got to know them, was through one of the founders of one of their angel investments. Previous to that, I had spent time in the Bay Area doing M&A work, had been with another venture fund in the area. And then I had spent time at Qualtrics and in Structure, was with Qualtrics as they raised their Series A, and was with them through about 500 employees. And then I was within Structure for a fairly short amount of time. And so I got to know, I joined Peak Ventures kind of from Instructure on the founding team. And kind of the premise was there's a lot of great companies being founded here. And a lot of those companies, especially in the past, had been bootstrap companies and had to raise money kind of from outside the area, or just, kind of had to get to a certain stage where investors and equity investors were interested in them. So our founding thesis was, hey, there's some good funds in the area, but there is room for one more early stage fund. And, just with all the activity and the depth and breadth of everything that's going on here. And so we raised a $20 million fund one, and, frankly got, fortunate and lucky on a few deals that got us kind of kicked off in the right direction. And, that helped us raise a fund two. We raised that in 2016. And then just last year, we raised our third fund, 75 million. And we have one opportunity fund. But overall, I mean, we have around 150 million under management, a little more than that, but, and we've invested in about 60 deals at this point. About about 75% here in Utah. And then we do a lot of work in the Mountain West area, but we also, as deals get referred to us through, other co-investors or through our entrepreneurs, we will do deals outside of the area as well. So that kind of brings us to this point. We rebranded to Album last year with the launch of Fund 3. So you asked a few questions at the start. I don't know if you want me to jump in there too.
I think we can get into it. I mean, I wanted to comment on, my view of watching Album kind of evolve over the years too. I mean, one of the things that I love about the way that you operate as a fund is that you're very much aligned with founders. Your founding team and you have worked inside the trenches with founders before you ever founded Album, which gives you a really unique perspective, I feel like. And I feel like at least the exposure I've had to the way that you interact with founders in terms of term sheets and that sort of thing is you're very much aligned with the founder's upside, more so than just, muscling in some downside protection, so to speak, that isn't always very founder friendly. And I like that about you, that you look to the future and to the growth that everyone can create, and you're betting on that. And I really like that alignment with the founders in terms of picking great founders that are going to be able to perform and helping them to achieve their best rather than betting or having to hedge your downside on every instance. So I really like that about you guys, and I think that your reputation is really starting to precede you.
Right. Thank you. No, I appreciate that. I mean, we worked hard to figure out ways to, try to be as aligned as possible, and just naturally where we sit on the cap table, we kind of figure our equity basically sits in the same spot as the founders. And so it's not really to our best interest to, put any wonky, weird terms in there. We're more focused on stage, founding team, and the market opportunity, realizing that, nobody wants to lose money. We have fiduciary responsibility to make money, but, we're trying to find kind of off the beaten path, non-consensus things. And so, we don't see a lot of reason to have downside protection. I mean, you can lose your money once, but you can kind of, name your multiple on an investment. So that's how we view it. And we get our diversification and our downside protection through the portfolio. So we're investing in around 20 to 24 deals. And so that's kind of where, rather than kind of ensure you're going to get your money back on every deal, it's like, we kind of get that through the fund structure.
Yeah, that's fantastic. And I love that approach. Maybe just really quickly comment on some of your more successful investments that the audience may recognize.
Yeah. So I guess start from the beginning. I would say Podium has been probably the most high profile. We invested in 2 rounds. We led 2 seed rounds there, kind of from the beginning. There was 3 of them. I can't take full credit. I did not source that one. I was involved with the investment process, but and sat as a board observer for a while, unofficially. But they kind of, it was pretty informal at the time. But now they've gone on to raise a lot of money. They raised a C round from Y Combinator Continuity Fund, Sapphire. They have IVP in there, Excel, and Summit. So that's a pretty well-known company. One of the fastest companies to reach, 100 million ARR. Other ones, if you're in the Mountain West area, a lot of people know Homey from the billboards. Now they've kind of expanded to multiple states. So, and doing quite well. In our second fund, we've got a bunch in the first fund. I could name a few. We just had an exit with one called SaltStack to VMware. We're also in Weave, We're into greed. Second fund, we've got Divvy. We've got some great up and comers like Filevine, Route, which you and I had briefly talked about, just growing, I mean, insanely fast, and one of the rare companies that has seen just a massive tailwind from the current 2020 environment as everybody shifted to e-commerce. And then fund three, we're on fund three now, and you know, these are not deals that you would probably recognize, but we have some really good up and coming deals. Wistic here in Utah. We've got one in Austin, one in New York. Let's go look at the website. But yeah, I mean, I don't want to name them all, but you know, it's mostly B2B
we won't
SaaS
say
and marketplaces. Yeah, B2B SaaS marketplaces and the really buzzy future work. But our future work is kind of, yeah, some ed tech, some kind of workplace tools, that kind of stuff. So
yeah, that's awesome. Well, clearly you guys have done a great job of helping to create the wave that's happening in Utah. So let's jump into the topic here. You know, so setting aside hitting all of the correct data points in a deck, let's talk about the storytelling side that really comes out when you dig into due diligence and understand where these founders have come from to the point. And let's just make the assumption that they haven't raised any money yet. So coming to you with, you know, maybe a little bit of friends and family, but mostly just gotten there themselves. Obviously, there's a lot of different areas that we hit on, but maybe we just start with you just commenting in a couple of minutes when you know, once someone's passed the first interest test of getting through the deck and seeing that there's really something worth looking at, what are you looking for after that point?
Yeah, it's a great question. And I mean, it's hard to give general advice to an audience that I don't know exactly, you know, it's hard to give kind of broad-based advice, but I think how I'd approach that is, I think people think that, you know, we've got a checklist or we've got some kind of a certain revenue threshold or growth rates or, you know, something that we're looking at. Although those are important, and, you know, we do have kind of a rubric that we're kind of going off, even if it's kind of informal and just something we, you know, passing the sniff test. I would say it's initially it's more, you know, kind of where did the intro come from? That's a big piece. So getting introduced through like a founder or through our network, someone we've worked with in the past, just somewhere where, you know, you're able to cut through some of the noise a little bit and kind of answer the why question. So, you know, I don't think we're the ones that invented this, but we look a lot at the why this team or this founder or founding team, why this opportunity and why now. So I would say that's probably the sniff test that is most important to us, is answering those three questions. And so we like to see founding teams that have, I believe it was A16Z who said it first, like founder market fit. It's like, there's got to be a reason why this founding team is doing what they're doing. And, you know, there's another concept, like they've gone through the idea maze. They've either lived a certain experience, or they have tested this idea, or they've, you know, kind of spent years doing something that kind of brought them to this point. And they have some sort of a kind of insider secret, essentially. And then, you know, why this? It's kind of, that's kind of the answer to it. It's like, what is it about this that is kind of coming at the market in a new way? And then I would say another piece is, you know, we do invest in things that don't always look on the surface all that interesting initially. And it's because we try to find a why now. So that means, you know, why couldn't this exist 5 years ago? And why, you know, in 5 years, if we wait, why would it be too late? And or like, why does it become really interesting in 5 years? So you're looking for markets that are kind of like, you know, kind of look small or uninteresting today, or kind of very difficult, or, you know, just looked over, and why like some, you know, big trend or something like that is going to make it super interesting. So I think a good example of this one is like a Neighbor. If you've heard of Neighbor, it's doing quite well. It's you know, people are dubbing it the Airbnb of storage. It's
I saw they just got highlighted in the Wall Street Journal, right?
They did, yeah. This week they got a nice feature in the Wall Street Journal, which was great. So we invested in their first 2 seed rounds back in 17 and 18, I believe. And it's kind of the why now. It's like this idea has actually been tried quite a few times. And, we kind of felt like there was a trend, and people are starting to be a lot more comfortable with, kind of strangers and letting people in their house and just kind of like, a lot of these companies like Uber and TaskRabbit and all these have kind of paved that way where you can build real trust in through the platform. And so now this is asking people to say, hey, open up that RV pad on the side of your house and let someone park their boat there, or, let someone park their antique car in your garage, And so it's like, it kind of looks crazy. And I'd say sometimes the hallmark of a good idea is like, you mention it to someone that's never heard of it, and like half the people think you're stupid or crazy, or like kind of turn their head and say, what are you talking about? And like half the people are like, love it. Like, you got to have an early love group. So yeah, I'd say that's kind of that's a long-winded answer, but I would say that's more so than like trying to fit in a box. Like, we try to understand our box really well. Like, what are we looking for? But I would say if we look back at all of our investments, it's like there's always kind of this edge. Like, the best ones are a lot of times an edge case, but you got to understand that it is an edge case and why it's an edge case, and that those tend to be sometimes the best investments. So, I mean, one thing I think we found is like, it never gets easier to identify and find the right best startup. Yes, we have more of a brand and a reputation and kind of more, capital deploy. So it makes it easier to kind of be flexible in how much we can put in. But it's like every deal is kind of unique in kind of the way we find it, the way we diligence it, and the reason why we do it. And I would say the only thing that kind of is, maybe the common theme is, where did that deal come from? And then why this founding team, why now? Or why this opportunity, why now? So yeah.
I love that. Yeah. And I mean, from an investment strategy perspective, I like geeking out on that, because I mean, ultimately the biggest wins are the ones that were picked up before it was a trend, right?
Yeah.
Because if you pick up on, the third Airbnb competitor, you're not going to win like Airbnb did, right?
Yeah.
And maybe that's a weird example because Airbnb took that whole market. But,
yeah.
I think understanding how to get ahead of that curve is important. So if we examine that, I mean, to what degree can the founder influence your thinking on that? Is their setup important, or is this totally independent thinking? It has nothing to do with what the founder says?
No, I think there is some lessons from the founder. I think, I've met with, it could be tens of thousands, if not 10 of thousand entrepreneurs at this point, this many years in. And excuse me, I would say one thing that is a lot of times apparent as you get to know these entrepreneurs is this entrepreneur and founder a missionary or a mercenary? Are they in it for the money and like just kind of, is this something that they're just looking for a quick flip, or is it just profit motivated? There's nothing wrong with, trying to become a 100 millionaire or billionaire, but it's like, if that's kind of the motivating factor from the beginning, I think it's sometimes flawed and not as pure. So I think we kind of look at that and scrutinize it and look for clues there. So a missionary is someone this is like their life work. It's almost like this is someone who is doing this because, like I mentioned, they've got kind of a unique insider secret, or this is something that they just can't, they've had this problem themselves, or they can't really live their life, without trying to solve this problem. So it's like, it's pretty apparent. I'm not trying to be overly dramatic about, it's like, we're talking about software here. So it's not like we're curing cancer. Like, we don't do cancer drugs. So, but it does become apparent when a founder has something kind of unique, and they're not just like, hey, we're going to get a quick exit in 3 or 4 years. There's nothing wrong with that. That's a fine strategy, but our fund, it doesn't really fit our mandate. And then I would also, say the founders, like most companies that, kind of reach big heights, it's best if you go in kind of with the mindset, I'm going to spend at least a decade on this, and like be very comfortable with that. We're doing it the same here. We've got we've got 3 funds right now. Fund 1 started in 2014. We're still in that fund, like very much so. Like we're working with a lot of those fund 1 companies, still waiting for a lot of liquidity on a lot of these. So it's like, we think in 10-year increments, and sometimes I think founders, I think you should also think in 10-year increments. And then maybe the last thing, I think, this might sound a little strange coming from an early stage investor, but I think a lot of founders kind of go into things with a default assumption, I should raise money. I would actually say the default assumption should be I'm not going to raise money, and I'm going to try to do it without it. There's a lot of reasons: control, making sure you're focusing on something the customer really wants. Money can make you lazy. I think there are 2 reasons why you should raise money and when it makes a lot of sense. And this is something we look at. So it's like you can this comes out in conversations with that entrepreneur. We look for times when it's a very technical product and there's like a J curve. So they have to build something and get it to a certain point before it's actually sellable, or before they can, fully reach that, kind of good margin or something. So that's a good reason to raise money. And then a second, I think, is kind of that why now. And that's probably where a lot of our investments have fallen, is there is a window of opportunity and they have enough evidence that, yes, this is working and now I should raise money. So there's nothing wrong with saying, hey, I'm going to raise money from day one to put a team together. But I think if possible, it's best just to go as long as you can without it. Use money as fuel more than kind of, to kind of figure it out. So I know that, that's easy to say because look, I'm sitting here, not starving. Like entrepreneurs, have lean times. I get it, but it's like, sometimes there are other ways to kind of, launch a business while you're kind of got a side hustle, or you got whatever, or try to get early revenue from some customers, whether, I know services is kind of a swear word for a lot of VCs, but like there are other ways to kind of figure out how to do it. I just think you're gonna raise at better terms. You're gonna have more clarity into what the market really looks like. Your pitch is gonna be tighter, and I just think you're laying a better foundation.
Yeah, I totally agree with you. If we can dig into that for just a second, theoretically, if a company comes to you and they're more advanced, I mean, let's just say they haven't raised outside capital, but they come to you with, 3 times the revenue of your typical company, right? And they've got a product that's built out, they've got a well-established customer base and more momentum than typical, right? Tell me how you view that from your perspective, because those elements in many ways kind of work against you as the investor, because now, the ball is kind of in their court because they are more advanced and they kind of in a way get their pick of the litter of who they get to work with from an investor standpoint. So is there ever a point where maybe they've gone too far and, it's like, no, this is now not to my advantage, because not necessarily because of stage, right? But because they're going to demand terms that maybe don't match what you need. Is that even a thing, or is there no such thing as being, further down the road?
Yeah, I mean, look, FOMO is a thing, and we have a stage that we stick to. So yes, that's a thing. I mean, we do miss out. We miss out on deals sometimes, and it gets beyond our stage, and it just doesn't make sense for us anymore. I think the stance we've taken and the philosophy is just, hey, we're not going to be right for everybody. We're going to miss quite a few deals. The ones we do, we hope that there's tight alignment. And just to be clear, I'm not talking about, hey, you should get to 10 million in revenue before you raise any money. I'm more saying you're thinking of leaving a job, and it's like, once I raise 250K, then I will start. It's like, I'm saying start, figure a few things out. You might still be pre-revenue when you raise money, or you might have 5,000 a month in revenue, something small. It's like, that's all I'm saying, is just get a little bit further down the path. But going back to what I was saying is, I just think it's a long enough journey. And at the early stages, I would say we don't think of, doing a deal, like really doing a deal is not really our kind of in our vocabulary much. It's more, it's finding a company that fits with us. Is there something that we add as well? So one thing I didn't mention is kind of in that why, it's like, why us as well? So, there are companies that we've seen. I mean, I can think of 2 or 3 right off the top of my head where we waited and waited and waited. They grew, and now they're outside of our bounds. And it's like, we no longer make sense. It's bad for us, great for them. I would say the only thing is, sometimes I've seen bootstrapper companies have a hard time raising capital because a lot of times they think, oh, when I hit X ARR, X kind of metric, then I will raise money. But there is something to be said about velocity of getting to that metric. A lot of people kind of say 1 million ARR and then I'll raise. It's like there's no real magic number, I wouldn't say. It really depends on the market size. And I would say velocity is a bigger thing. But to answer your question more directly, yeah, that's kind of a thing, but we don't worry about it that much. We kind of take a little bit more of a long view, or at least we try to, and say, we want what's best for the entrepreneur. And, we're going to miss a few companies that way, but there's a thing called karma, and just being kind of having a reputation, and like, there's a lot of companies, that fly past us, and then hopefully we gave them a good experience, or they kind of had a good interaction, and they refer us to that next deal. And that's kind of how we think of it, and kind of, just make it's fine. Like if we miss a company. So yeah, I don't know if that answered it fully, but
no, I think that's great. I mean, at the end of the day, I think that what's clear too is that there is no formula, right? And maybe you can comment on, outside, your interactions with other GPs at other funds. I mean, from my experience, that there is no real formula. I mean, there's kind of maybe a couple of check boxes, but it's more about the things you're talking about, the whys, right? Understanding that. And I think a lot of founders, they read a lot of books and a lot of blogs and whatever else that say, hey, you need to have X, Y, Z, these 6 check marks, and you're going to get funded.
Yeah.
And it's not necessarily the case, right?
It's not always that case. I think those are sometimes helpful, just because you can't just say, hey, you just got to throw, hope that you raise your money. You kind of need to have something, some structure. So I know in that sense, I'm not being that helpful, but I would say more than anything, I think there's a great post from Mark Zuster that a lot of people reference, the lines, not dots. And that kind of sticks in your brain. I think that's true. I think an investor, if you're going to be on a journey with a founder and vice versa, a founder with an investor for 10 years, make sure you like them, and that there's chemistry, and they're not going to be a bad actor, and that there's a fit there. So I think you best accomplish that through kind of lines, not dots. So lines, not dots, meaning you kind of need to see, a few data points along a continuum, rather than like, hey, we're raising our round. Can we meet next Tuesday? We're doing term sheets, the following Friday. It's like, okay, that's cool. And a lot of people raise rounds like that. There's nothing wrong with that, but it's just a lot harder to come to conviction under that. And I think you just got to have kind of your company has to kind of stand on its own merit, because, I think it's just good to get to know the investors, and for the investors to get to know the founders. So I would say, but there are 2 things that I've seen that really help in raising a round. And I mentioned one of them, FOMO. FOMO is a real thing. It's kind of that thing where if we miss out on a deal, I mean, that could mean 100x if it's a really good deal. It's like, what is it? Type 2 error or whatever. It's like, if you gamble and you're wrong, if you say yes and you're wrong, you lose 1. But if you say no and it's, it goes, it's like you missed out on a massive ride. So it's like FOMO is a real thing. You can't overplay your hand, and you have to have a very credible hand. But like, if the thing's going and like, this is our last chance to get in, you're definitely going to get most investors to perk up a little bit and like pay attention. And kind of the connected piece with that is velocity. I mean, something that is this business is built on, kind of a power law where the top 25% is going to return 75+%. It's kind of the Pareto principle. And so, you got to make sure you're in really good stuff. And the ones that are showing velocity, a lot of times, like an object in motion remains in motion. And, it just takes a lot more conviction to write a check into something that is kind of like, trust us, we've got a pipeline, we've got we've got a product that's going to be launched, and it's a harder stretch. And so that's where the lines, not dots, and like the founder story and like the vision comes into play a lot more. You kind of gotta optimize on the vision, rather than just like,
well, especially at the early stages that you're looking at, I mean,
yeah,
momentum is there, but it's there in a different way than when someone's raising a Series A or a Series B.
yeah,
That's really heavy metrics driven, right?
right. Yeah, I think you got to give people just some assurance that, there is real demand in the market. I think a lot of the best investors are looking for, something that's durable, something that's easy to explain. Sometimes complicated ideas work, but like it's a lot of times it's the very simple focused stuff that works. And then something that has like, so I said durable, kind of simple, like unique insight. And then the third I would say is something that has like what's the word? Like a sustainable, like recurring nature to it. So some investors do a lot of CPG stuff. I don't know what your audience has, but like we don't do a lot of that. Like, but you're going to get a better value and it just a lot more assurance if you have some sort of data on the persistence of your revenue. That's why SaaS gets massive multiples. It's like, you finish out December 31st and January 1, say you finish with 10 million revenue, you start January 1 with 10 million in revenue basically, and you're just building from there. Whereas, if you're kind of doing one-time sales, it's like, great year, cool. Now January 1, let's do it again. You start from zero, So anyway, I think those are things that really help if you can kind of tell that story and kind of, because most investors are just looking for something that can be highly profitable, highly defensible in the far future. And so it has to have some of those elements, or at least kind of some way to logically map to those elements.
That's great. So let's shift gears for a second. Yeah. And, that's talking about the positive side, looking at all the good momentum and you're matching up on the why and the long-term vision and everything else. So let's talk about the skeletons in the closet, right? I think most businesses have not always had a perfect path to victory, right? To getting to you. And during the, due diligence process, there's a couple of different things we could talk about. Let's just assume that you discover something that's not optimal. When you're talking to a founder and you understand that, a key co-founder left 3 months before, or, the product's not as well built as it should be, or, whatever other thing might come out of the woodworks after you've kind of aligned with them and said, yeah, we're really interested in this. What's the best way for a founder to tell those parts of the story that are inevitably there and need to be told, but without, kind of stabbing themselves in the leg with the relationship with you?
It's a great question. It happens. I mean, kind of going back to that long-term relationship, I think any good relationship is built on trust. So I have noted, a lot of founders do feel that like, I got to make the business look perfect. I got to, everything has to, be kind of right in line or else, but I think vulnerability can actually be a strength. Saying, I don't know is sometimes okay, and say, that's a great question. I hadn't thought of that. Let me go do some research and get back to you. On the co-founder issue, I think getting that stuff out there. Now that can be sometimes like if you didn't have a vesting schedule or if there's like a dead piece of the cap table, like those things can be really real hurdles to get over, just because you're starting off on a very, kind of difficult standing. The product piece, can be changed, but I guess, I hate to be a broken record, but kind of going back to that, kind of cadence of touch points, you hope that there's like a bit of trust there. And, it's kind of at the stage we're talking about, given this is kind of targeted towards founders. I think, I think the best tact is just kind of having developed that relationship of trust, vulnerability, and kind of knowing inevitably these things are going to happen. And so it's not all that surprising. So I would say if these are known skeletons, get them out early. It's kind of like, just get it out there and kind of, if there's a good explanation for it, because there might be a good solution for it too. So I'm not going to say it's going to work 100% of the time. It could be actually the reason why you don't get funding, but it's also, you'd rather kind of have it come out now rather than later is my sense.
So what would be the best way to present that? I mean, do you have like here's my skeletons deck and I'm going to walk you through all my problems. I mean, it doesn't need to be that obvious, right? But
yeah,
I mean, you also, you want to be forthright, so is this like where you're chatting, after the end of a discovery session, you're like, hey, by the way, there's a couple of things that I want to make sure are clear. And you line out the one or two items you want, John to know about. I mean, is that the best way to do it?
Yeah, I don't know there's one right way. In every kind of situation is going to be different context, but yeah, I mean, I think it just kind of comes out during the discussion and say, if it's a co-founder issue, you start talking about, how much money do we need to raise, and like what team members do we need to have, and like, what, hey, that we actually have had a couple team members that had to depart. It was very painful. One of us sued us. We're still going through that. It looks like XYZ is going to happen. It's kind of like I would say that's kind of how you bring it up and you just talk about it. But yeah, I mean, inevitably something's going to come out at a certain point. But yeah, I don't know that I have like a silver bullet answer to like what's best, but
yeah, I'm sure all the preferences are different across the board anyway, right?
Right. And I would say, it's as much as possible. And that's just like with us too, when we raise money every 2 to 3 years. And so, that we have things that we have to kind of be ready for, and you kind of know your skeletons, the ones I would say most people do. And so it's like either try to take care of them ahead of time. If you're going to go into a fundraising process or kind of even just, but well ahead of a fundraising, it's like, hopefully you're meeting with people, ask advice about it. Hey, I have this issue. Just kind of, you see a lot of this stuff, ask those investors, ask your mentors, ask your advisors. So I think that's how I would go about it. But yeah, you certainly don't want to kind of get, kind of a bad mark, like, oh yeah, we're cursed and we can't, raise money. But I think you can kind of take care of some of those issues ahead of time if you kind of, anticipate that.
Yeah, no, that's great. This is really insightful, I think, for so many founders to be able to get in, and understand and hear from your perspective. Because so much of what you read about is just like, have the perfect pitch deck, make sure that you can answer these key questions. And, if they like you, great. If they don't, then you move on until you find someone that likes you. And I think that there's, it's just as complicated to navigate the due diligence process as it is to get a second date off of a pitch deck or a coffee meeting, right?
Yeah. One piece of advice I would give, I think a lot of founders kind of feel like it's like a job interview or something like that, or like I'm applying for funding. Like I've actually heard that a few times. It's like, that's not how we ever think of it. It's not like, hey, put in your application, we'll approve or deny. It's more, it really is a developing partnership, and hopefully the early stage investor, you're kind of viewing it as almost like a financial junior co-founder, essentially. Like it's almost as if you're kind of interviewing. So you are doing the interviewing, the founder is doing the interviewing. So I would actually challenge most founders to turn the table a little bit and say they should be asking more questions almost than they're answering sometimes. Like they should be kind of going to the, like, tell us about your firm. Like, hey, tell us about your experience. Like, how do you like to work with portfolio companies? That, you don't want to get annoying and just kind of make it a point to be like, okay, this person's just trying to ask questions, so they don't have to answer questions. But I think it should be viewed in that way. I think that's a healthy way that a lot of founders, kind of not turn the tables to like for a power dynamic or anything, but out of a genuine desire to have a partner. Hopefully the founders kind of view it that way, because I know the power dynamic sometimes is early stage team does not have money. VC has money that they're trying to invest. And so it's hard to, there is some leverage there, but it's like, look, you're building a company. If you're truly passionate about this, who cares if it takes 2 years, 8 years, 10 years, 15 years? Like, hopefully you've found something that you're passionate enough about that it's like you're winning not because you become a billionaire, but because you're doing it and you're doing something that you believe in that's, hopefully changing the world. So, yeah, anyway, that's kind of my, not trying to be too, I don't know, too impractical about it, but I think, it is a transaction at the core, like we are doing a legal transaction, but it's also like view it, especially like your seed and series A rounds, almost more than a partnership than like a financial transaction. When you're raising a series D or E, I know they talk about partnership there as well, but I'll say that's going to be much more of just a pure negotiation, more numbers, kind of does this machine work? And that's kind of a little bit different process, but I'm talking strictly about angel, seed, series A.
That's really good. I like that. We've got one question that came in, and then I just want to give you a couple of minutes to kind of provide advice for founders that are going to be coming into this stage. So in raising a seed round for capital intensive startup, is it easier on VCs to break up the seed round into two offerings? Or I'm assuming the other side of this is, or should founders be looking for investors that can take it all the way?
Yeah, that's a good question, Isaac. I would say, I don't know that I have the answer that's going to apply to everybody, but I think good advice is, so when you raise money at the early stages, theoretically, assuming it all works out, this is expensive money. And so, yes, it would be nice if you just raised a big slug up front and never had to raise again. But I would try to look at the, kind of how you anticipate the growth of the company to go, and chop it up into like, what are the inflecting milestones? Usually in a startup, if there's going to be milestones that like have certain inflection points. Like in a hardware company, it might be, I don't know, getting your first version of it, or, kind of hitting some milestone. Like it's pretty clear in like a pharma, we don't do pharma, but like they go through studies, like they go through zero revenue sometimes and raise hundreds of millions of revenue, but it's like they have the big inflection points that are step functions. I would say, try to do that to your hardware tech, frontier tech, and say, what are the big inflection milestones? And then say, what do we need to raise to hit that next milestone? And just for some cushion, maybe gross it up a little bit, because it usually is going to be more expensive and take longer than you think. But it's like, just raise that enough money to do that. And it could be small milestones. It could be like, hey, we're going to recruit these team members. We're going to do a Kickstarter, kind of crowdfunding. We're going to do, so let's just like hit a few of these milestones so people can say, oh, this is actually happening, and there is demand in the market. And oh, okay, they've got the right suppliers. Like getting the right suppliers could be a milestone. Like there's certain things like that I think you can kind of break it up. So I would say, look, if you get, a crazy strategic firm that's like, we believe in this vision and we'll take the 5 million now and kind of get you to a Series A, go do it. But, if you don't have that luxury, or, I would say tranching is usually a little better, but, sometimes tranching can be viewed as a bad thing too. You don't want to get an investor usually that's like, I'll just drip in money like month by month and kind of make a decision every month if I'm going to keep doing it. You kind of want to raise in like a big enough window where you don't have to think about fundraising every month. You kind of want to have 12, I think 9 months minimum, probably 12, and then maximum probably 18 to 24 months. That's kind of how I think about it.
That's great advice. And capital intensive startups are hard that way, right? When you got big milestones to hit before you can generate revenue, it's a different game.
But frankly, I mean, that's not really the business we're in. So take that for what it's worth. But I think, as I've talked with other investors and kind of seen a lot, that seems to be, fairly decent advice.
That's good. Well, let's just give you the last couple of minutes. I mean, if you're facing founders that I think have the aspirations to raise venture funding one day. So, I mean, if you're going to leave them with a final thought from your perspective, what do you want them to know?
Ooh, that's a big question. Let me think. So, yeah, I think, look, find a firm. If we're just talking strictly about raising money, it's like, find a firm who kind of can align with your vision, and can kind of, I mentioned like the junior co-founder thing that can, the way we view the best investors and what we try to emulate is we want to be the team that can be a shock absorber to you. we don't want to make our founders' lives any harder than they have to be. So, we don't dictate a lot of how they run the business and kind of the little decisions they make and hiring. We want to do nothing but be accretive. And so, that can be through hiring, fundraising, and then just, being someone that they can call. And it's always great to get good news, but more importantly, even like someone that we want to be the first call when there's bad news as well. And so I think finding an investor like that is important, especially at the early stages where you're going to see a lot of winding and turning and ups and downs. And so maybe my parting advice is don't view kind of financing, because that's what we're talking about, as much as a transaction. View it as a partnership. The second piece is sometimes the hardest part is just getting that opportunity to be in front of people and develop those relationships. I personally believe the best way to get in find that, go through Crunchbase, go through whatever source you want, like find a list of 12 or so investors for that next stage and go look at their portfolios. You may be connected to some of their founders or at least their teams. And I would say that's the best way to get introduced to people, is through their portfolios. And a lot of times founders are willing to help kind of the founders that are a stage or two behind them. And so I think that's a very good way to kind of get introduced, but maybe even more importantly, you will learn what kind of investor that investor has been for the founder. And so you kind of serve a dual purpose. You can kind of screen your way into very good investors. And so hopefully that's kind of helpful advice. And yeah, I think that's basically it. I mean, look, I'm not a founder right now, and we don't want to sit here and make it sound any easier than it's really, really difficult, and we understand that. So I think I would just say, like, find something that you are, kind of passionate about, that you've got kind of inside track on. And, I don't want to get overly philosophical, but it's like, I think I had mentioned it. It's like you kind of will win just by doing this startup, if you actually believe in what you're doing. And so that's kind of, I think, the best way to change the world and kind of actually make something big come into existence. And that will shine through. What that will do is you'll be able to raise money easier and attract talent easier. So
love it. Yeah, that's awesome advice. John, thanks for spending time with us. I think that a lot of people look into this world and think that it's secretive and difficult to understand, and it's always everybody else talking about it. So to hear it directly from you is very valuable. So thanks for spending time. And I think we'll be recording this and we'll be sharing it out with the community and whatnot. So thanks again. And
yeah, thank you, Jesse.
Yeah, we'll see you here soon, personally.
Sounds good. And thanks everybody for joining. We'll see you.
Awesome.